Switzerland, long a symbol of economic stability and prosperity, has always been admired for its resilience in the face of global turmoil. Its pristine landscapes and orderly cities have often mirrored the country's reputation for financial discipline and security. But now, the unthinkable has happened. Switzerland has just posted a rare and troubling contraction in its economy, sending shockwaves through financial circles both at home and abroad. This isn't a temporary blip or a minor setback. Switzerland, which weathered past European crises unscathed, is now flashing a warning for the entire continent. The downturn is broad and persistent, raising serious questions about the future. Exports to the EU, Switzerland's largest trading partner, are down sharply. Manufacturing, once a pillar of Swiss strength, is hurting as global demand weakens and supply chains falter. Even Swiss consumers, known for their confidence and spending power, are pulling back, worried about rising prices and job security. Deep integration with Europe means Switzerland is now feeling the full force of its neighbors' troubles. Economic pain is no longer contained by borders. It flows freely across them. The Swiss National Bank's years of negative interest rates, once seen as a bold experiment, couldn't prevent this downturn. Instead, it has highlighted deep structural issues that even Switzerland cannot escape. Unlike in past crises, Switzerland is no longer a safe haven. It's being pulled down with the rest of Europe, its famed financial sector now facing the same uncertainties as its neighbors. The interconnectedness that once fueled prosperity and growth is now spreading economic pain, making recovery more difficult for everyone involved. Switzerland's contraction is a canary in the coal mine, a stark signal that Europe's economic foundations are under severe stress and could be at risk of further deterioration. The tremors from the Alps are just beginning to be felt across the continent and beyond, hinting at deeper challenges that may soon reach global markets. The message is clear. If Switzerland with all its strengths is struggling, then no one in Europe is immune from the growing economic storm. The world should pay close attention, because what happens in Switzerland today could be a preview of what's to come for the rest of Europe, and perhaps the world. Across Europe, a dangerous paradox is emerging, one that threatens the continent's economic stability and the livelihoods of millions. High unemployment persists, even as businesses post a record number of unfilled jobs. This contradiction is leaving both workers and employers frustrated, unable to find the right match. Economists call this the beverage moment, a clear sign of a deep and growing mismatch between the skills workers possess and the qualifications employers desperately need. In Germany, for example, unemployment is ticking upward, yet manufacturers are scrambling to fill positions for engineers, technicians, and skilled tradespeople. The talent gap is widening, even in Europe's industrial powerhouse. France faces a similar dilemma. Joblessness remains stubbornly high, especially among the young, while tech and advanced manufacturing firms struggle to hire. Many blame rigid labor laws, outdated education systems, and a lack of vocational training for the disconnect. In southern Europe, the situation is even more dire. In Italy, youth unemployment has soared above 20%, leaving a generation at risk. At the same time, small businesses and workshops can't find the skilled workers they need to survive and grow. Spain's economic recovery is stalling for the same reasons: a massive skills gap and a lack of opportunities for young people and experienced workers alike. The result? Companies delay investment, projects are put on hold, and workers remain stuck in limbo. The broader economy stagnates, unable to tap into the full potential of its workforce. This cycle traps talent in declining industries, blocks the growth of new sectors, and leaves entire communities behind. Europe's economic engine is stuck in low gear, with no easy fix in sight. The consequences are felt not just in boardrooms, but in everyday lives across the continent. Unless Europe can bridge its labor market divide, the mismatch will remain a major drag on the continent's future, threatening growth, innovation, and prosperity for years to come. The official story from Berlin is one of resilience, but leading German economists are sounding the alarm. They point to weak GDP growth, falling industrial output, and plummeting business confidence. The Berlin bazooka of subsidies is now seen as wasteful, propping up uncompetitive industries and delaying real reform. Critics warn these policies treat symptoms, not causes, and trap skilled workers in zombie companies. Germany's rising debt makes this approach unsustainable. The economic establishment is losing faith in government strategy, Their message: without structural reforms, Germany and Europe face stagnation and decline. The time for bold change is now. The old playbook no longer works. The myth of European resilience is unraveling. Beneath the surface, near-zero growth, high inflation, and economic anxiety dominate. Germany's growth is flat, its auto and chemical industries are struggling, and France and Italy are adrift despite huge stimulus. The banking sector is a hidden risk. Rising rates have slashed the value of bonds on bank balance sheets, leaving some technically insolvent. Corporate and real estate sectors are squeezed by higher debt costs and falling demand. Commercial property values are dropping, but losses are hidden, threatening banks further. The feedback loop is clear: weak growth, fragile banks, and a shaky real estate market. The cracks in Europe's economic foundation are widening. The day of reckoning for banks and businesses is approaching. The official narrative can't hide the mounting vulnerabilities. Europe's resilience story is collapsing under hard evidence. Europe's economic slowdown is setting off a destructive domino effect that ripples through every corner of the financial system. What starts as a dip in growth quickly becomes a chain reaction, with each sector feeling the pressure and passing it on to the next. Struggling companies are the first to feel the pain, as falling demand and rising costs squeeze their profits. Many are forced to cut jobs, delay investments, or even shut down entirely. This puts enormous stress on banks, which depend on healthy businesses to repay their loans, and soon the pressure spreads to the real estate market. As profits fall and defaults rise, banks face mounting losses on corporate loans and devalued government bonds. Their balance sheets weaken, making it harder to lend and support the wider economy. Investors grow nervous, watching stock prices and bond values tumble. A few big bankruptcies could spark a crisis of confidence, freezing credit and threatening the entire system. When trust evaporates, even healthy companies can find themselves unable to borrow or pay suppliers, deepening the downturn. Commercial real estate is the next domino to fall. As businesses close or downsize, offices and shops sit empty, rents plummet, and property owners struggle to cover their debts. Banks, already under strain, now face new risks from falling property values. Many losses remain hidden for months, masked by accounting tricks or delayed write-downs, creating a potential black hole on bank balance sheets. The true scale of the problem often emerges only when it's too late to act. The cycle is vicious. Weak companies hurt banks, banks tighten lending, more companies fail, and real estate values drop further. Each turn of the spiral makes recovery harder, and the risks greater. As investment dries up, jobs disappear, and confidence erodes, the effects are felt not just in boardrooms, but on every street and in every household across Europe. Breaking this downward spiral is Europe's central challenge. Policymakers must act quickly and decisively to restore trust and stabilize the system. But as the dominoes keep falling, the options for intervention are shrinking, and the window for effective action is closing fast. The risk of a full-blown financial crisis is growing, threatening not just banks and businesses, but the stability of Europe's entire economy. High energy costs are suffocating European industry. Even after the 2022 crisis, prices remain far above those in the US and Asia, putting sectors like chemicals and metals at a permanent disadvantage. Factories are shutting down or relocating abroad, hollowing out Europe's industrial base and destroying high-paying jobs. Government subsidies offer only temporary relief and pile up public debt, while delaying the shift to more efficient technologies. Without affordable energy, Europe's industrial decline will continue, threatening growth, jobs, and strategic autonomy. The continent's future as a manufacturing powerhouse is at stake. American investors can't afford to ignore Europe's crisis. The EU's $20 trillion economy is deeply linked to US trade and finance. A European recession means weaker demand for US exports and a stronger dollar, hurting American companies' overseas profits. If the ECB cuts rates, the dollar will rise, making US goods less competitive and squeezing corporate earnings. The bigger risk: a European banking crisis could quickly spread through global financial networks, just like in 2008. Many US giants, Apple, Microsoft, Ford, rely on Europe for up to 30% of their revenue. A prolonged European slump will hit US stock markets and investor portfolios. Investors should scrutinize their European exposure and brace for volatility. The transatlantic shockwaves could be severe. Europe's pain is America's problem too. Europe's leaders are trapped by economic and political constraints. The ECB can't cut rates aggressively. Doing so risks reigniting inflation. Fiscal stimulus is off the table. Debt levels are already sky high, and strict EU rules limit spending. Political fragmentation makes coordinated action nearly impossible. Populist parties and unstable coalitions block needed reforms. Europe's policy toolkit is incomplete and inadequate for the scale of the crisis. The continent faces a storm with few defenses. The outlook for Europe is grim. A long, grinding recession looms. Deep structural problems, limited policy options, and global headwinds mean the pain will last. Some see echoes of Japan's lost decades or the Asian financial crisis, but Europe's single currency and political divisions make recovery even harder. The denial phase is ending. Governments can't rely on subsidies or old narratives any longer. The next 2 years will test Europe's political will and economic resilience. Watch the banks, Germany's industry, and whether leaders can finally agree on real reforms. The warning signs are everywhere. The domino effect is underway. For investors and citizens, caution and clear-eyed realism are essential for the road ahead.